China's independent oil companies are making significant inroads into Iraq's oil industry, aiming to double their production to 500,000 barrels per day by 2030. This expansion is part of a broader strategy to capitalize on more lucrative profit-sharing contracts introduced by Iraq last year, replacing the previous fixed-fee agreements. These contracts have attracted smaller Chinese firms such as Geojade Petroleum Corp., United Energy Group, and Anton Oilfield Services Group, which are leveraging their ability to offer competitive financing, cut costs with cheaper Chinese labor and equipment, and tolerate higher risks compared to Western counterparts. As global majors like ExxonMobil and Shell scale back, these nimble Chinese companies are filling the gap, driven by the need to find new markets outside China's state-dominated oil and gas sector. For Iraq, the influx of Chinese independence marks a strategic shift in its oil sector, as the country seeks to boost its output by over 50% to more than 6 million barrels per day by 2029. The Iraqi government views the growing presence of these firms as a means to accelerate project timelines and reduce costs, with Chinese companies known for rapid project execution and a high tolerance for operating in challenging environments. This development could have significant implications for the global oil market, potentially increasing Iraq's influence within OPEC and altering competitive dynamics as smaller Chinese firms continue to expand their footprint in the Middle East.
The recent announcement of a 25% tariff on goods made in India by Donald Trump has sparked discussions in the tech industry, particularly concerning its potential impact on Apple's iPhone 17 pricing. Despite the tariff, Apple has managed to maintain stable prices for its new iPhone series. This stability is largely attributed to Apple's strategic supply chain management and its increasing manufacturing presence in India. By diversifying its production across multiple countries, including China and Vietnam, Apple can effectively navigate around tariffs and mitigate potential cost increases. This adaptability ensures that consumers will not see a price hike in the iPhone 17, preserving Apple's competitive edge in the global smartphone market. Apple's decision to ramp up local production in India aligns with its broader strategy to mitigate trade risks and capitalize on government incentives under initiatives like Make in India. This move not only helps Apple avoid import taxes, but also reduces the impact of external tariffs, allowing the company to offer competitive pricing in a price-sensitive market. By absorbing potential cost increases internally rather than passing them on to consumers, Apple maintains its market share and brand loyalty. This approach has proven effective during previous trade tensions, such as the US-China trade disputes, where Apple successfully kept its prices steady. As global trade policies continue to evolve, Apple's robust supply chain strategy remains a key factor in sustaining its market position and consumer trust.
U.S. factory orders experienced a 4.8% decline in June, a slight improvement over the anticipated 4.9% drop, as reported by the U.S. Census Bureau. The total value of orders stood at $611.7 billion, showcasing a notable decrease from the revised 8.3% increase recorded in May. Despite the downturn in factory orders, shipments continued their upward trajectory for the third consecutive month, increasing by 0.5% to $602.4 billion. Additionally, unfilled orders and inventories both exhibited growth, with unfilled orders rising by 1% to $1.47 trillion and inventories by 0.2% to $945.6 billion. The inventories to shipments ratio remained steady at 1.57, indicating a balance between production and distribution. The drop in factory orders is a crucial indicator of the industrial sector's performance, which plays a significant role in the broader U.S. economy. While the decline was less severe than expected, it still reflects potential challenges in manufacturing demand. The continued rise in shipments and unfilled orders suggests that while new orders are slowing, existing demand remains robust. This mixed data could impact market sentiment, influencing stock prices in the industrial sector and potentially affecting economic growth projections. Investors and policymakers will likely monitor these trends closely, as they could inform future decisions on monetary policy and industrial strategy.
XRP has demonstrated resilience in the face of significant market volatility this week, maintaining strong inflows despite a broader crypto market outflow of over $1 billion, largely driven by hawkish signals from the U.S. Federal Reserve. XRP's inflows dropped by 83.4% to $31.3 million from the previous week's $190 million, yet it remained the second highest altcoin for capital inflows, behind Ethereum. The decline in inflows occurred as investors moved away from riskier assets due to uncertainty over potential future interest rate cuts, triggered by positive U.S. economic data. Despite this, XRP's ability to sustain substantial inflows indicates robust institutional interest, particularly through products such as the Tariff 2x Long Daily XRP ETF. The Tariff ETF has quickly become the firm's most successful fund, highlighting the growing demand for regulated exposure to digital assets. Launched 16 weeks ago, it has surpassed all previous funds in performance and investor traction on the NYSE ACA exchange. This trend underscores a broader investor appetite for digital assets, even as Bitcoin experienced its worst weekly outflow since April, shedding $404 million. Ethereum, conversely, recorded its 15th consecutive week of inflows, attracting $133.9 million, as investors perceive it to be less volatile. Overall, the market's reaction appears to be a short-term correction rather than a structural shift, with XRP's continued inflows positioning it well among altcoins amidst changing capital allocations in response to macroeconomic signals.
Palantir Technologies Nasdaq PLTR has shown remarkable growth in 2025, with its stock surging over 112% year-to-date and an impressive 563% over the past year. This growth is largely attributed to key government contracts, including a $10 billion agreement with the U.S. Army and a $30 million contract with U.S. Immigration and Customs Enforcement, ICE. These deals highlight Palantir's strong foothold in government sectors, where its AI and data platforms are in high demand. The company's partnerships in the space sector with firms like Voyager Space and Starlab Space further underscore its strategic expansion into new and innovative markets. Palantir's financial performance has been notable, with revenue increasing from $1.092 billion in 2020 to $2.87 billion in 2024. Despite fluctuations in net income, the company reached profitability for the first time in 2023, marking a significant milestone in its growth trajectory. As a major player in the burgeoning big data market, projected to grow from $220.2 billion in 2023 to $401.2 billion by 2028, Palantir's continued investment in AI and machine learning platforms positions it well for sustained growth. The company's focus on modular sales and expanding its customer base, along with its strategic government and space partnerships, suggests strong potential for long-term earnings growth. Investors are keenly watching Palantir's upcoming Q2 earnings report, as the company has consistently beaten earnings per share (EPS) estimates over the past quarters. With its robust government contracts and innovative partnerships, Palantir is poised to maintain its momentum in the AI and data analytics sectors, offering promising prospects for long-term investors. However, the challenge remains in accurately forecasting the company's stock performance beyond the typical one-year analyst projections, especially given its volatile past performance and the dynamic nature of the tech industry.
Compass Inc. (Comp) has reported significant gains in market share, climbing to 6.09% in the latest quarter, marking a 96 basis points year-over-year increase. The company demonstrated robust performance with over 20% growth in revenue, transactions, and transaction value. Despite the broader real estate sector contracting by 0.9%, Compass attributes its success to strategic use of technology, mergers and acquisitions, and improved attach rates on post-sale services, which have collectively driven both top-line and EBITDA growth. Despite ongoing legal challenges with Zillow, Compass maintains a strong buy rating, supported by its scale, cost management efforts, and premium market positioning. In terms of valuation, Compass is trading at approximately 10 times its forward-adjusted EBITDA, which, while not inexpensive, is considered reasonable given its growth trajectory. This performance comes amid a broader market environment where investor enthusiasm is waning, particularly within the tech sector, as concerns over inflated valuations due to high expectations for AI persist. Nonetheless, Compass' strategic initiatives and market positioning offer potential upside, even as the market anticipates a possible correction.
Avant Gardner LLC, the operator of the Brooklyn Mirage, has filed for voluntary Chapter 11 bankruptcy in the United States Bankruptcy Court for the District of Delaware. This decision comes after several months of financial instability, exacerbated by the inability to open its newly remodeled Mirage event space for the 2025 season due to permitting issues. The bankruptcy filing aims to stabilize the company's finances, allowing it to continue operations at its other venues, Great Hall and Kings Hall, while planning a future reopening of the Brooklyn Mirage. Avant-Garde has secured a debtor-in-possession financing commitment from its existing lender, which will support its operations during the restructuring process. The company plans to enter a stalking horse purchase agreement, a strategy often used in bankruptcy proceedings, where an initial bid is set on the assets of a bankrupt entity, subject to a court-supervised overbidding process. This move is intended to facilitate the sale of Avant-Garde's assets to an entity formed and controlled by its existing lender. The restructuring is part of a broader strategy led by new CEO Gary Richards, who aims to revitalize the company's culture and financial health, ensuring the Brooklyn Mirage can reopen for the 2026 season. The situation highlights the challenges faced by entertainment venues in navigating financial distress while maintaining operations and planning for future growth.
Siemens Energy India has reported a significant financial performance in its first earnings release since going public in June. The company announced an 80% year-over-year increase in net profit for Q3 FY26, reaching 263 crore rupees, up from 146 crore rupees in the same period last year. Revenue from operations also rose by 20% to 1,785 crore rupees, driven by a 94% surge in new orders. This robust demand came from both domestic and international markets, bolstered by a strong order backlog and operational excellence. Siemens Energy's profit margin for the quarter stood at 17.6%, aligning with its normalized margin from the first half of the fiscal year. In response to growing demand, Siemens Energy has unveiled a 280 crore rupee investment plan to expand its manufacturing capacity for high-voltage switchgear products at its Aurangabad facility. This strategic expansion aims to support the increasing global and domestic demand for power transmission equipment, aligning with India's energy transition goals and the government's Make in India initiative. Following the earnings announcement, Siemens Energy's shares rose by 2.10% on the NSE, reflecting positive market sentiment. The company's focus on expanding its power transmission business underscores its commitment to sustainability and innovation in the energy sector.
The Financial Conduct Authority, FCA, has announced plans for a compensation scheme to address the ongoing car finance scandal affecting millions of UK motorists. This follows a Supreme Court ruling that favored lenders such as Lloyds and Close Brothers, reducing the anticipated compensation amount. However, lenders may still face liabilities ranging from £9 billion to £18 billion for agreements dating back to 2007. The FCA's involvement highlights the regulatory body's role in ensuring fair treatment for consumers, though the actual payouts may be less substantial than initially expected. The Financing and Leasing Association, Florida, representing the car loan industry, has expressed concerns about the feasibility of implementing a broad compensation scheme, citing potential challenges in record-keeping for agreements from 2007. The Florida has indicated a willingness to contest the FCA's proposal in court if it leads to what they consider disproportionate payouts. This development underscores the tension between regulatory efforts to protect consumers and the financial industry's pushback against potential liabilities. The outcome of this situation could significantly impact both consumer finances and the operational strategies of involved financial institutions.
BitGet, a leading cryptocurrency exchange and Web3 company, has launched its Crypto Experience Month 2025 as part of the Blockchain for Youth initiative. This campaign, now in its third year, aims to engage Gen Zs across Europe, Asia, and the Middle East by transforming the perception of cryptocurrency from a theoretical concept into a practical, everyday tool. Unlike previous years, this initiative moves beyond traditional educational formats, offering hands-on experiences in various applications of blockchain technology, such as payments, gaming, decentralized finance (DeFi), and creative expression. The campaign's tagline, "Look what crypto can do," emphasizes the practical utility of digital assets beyond market speculation. speculation. The campaign's activities are designed to provide tangible experiences of crypto usage, with pop-up activations in multiple cities throughout August. Participants can engage in activities like minting NFTs, experimenting with stablecoin lending, and exploring tokenized stock trading in real-time simulations. The BitGet Wallet, MasterCard, and PayFi's QR-based retail transactions are integral to these experiences, further bridging the gap between Web 2 curiosity and Web 3 confidence. This initiative reflects a strategic shift from education to interaction, aiming to build a deeper understanding and belief in the future of cryptocurrency among young people. By focusing on real-world applications, BitGet seeks to empower the next generation to integrate crypto into everyday actions, thereby fostering broader adoption. The campaign underscores BitGet's commitment to driving crypto adoption and aligns with its global impact strategy, including partnerships with major sports entities and educational initiatives. As the campaign unfolds, BitGet aims to demonstrate that cryptocurrency is not just a future possibility, but a present reality, encouraging young people to explore and embrace its potential.